Hi guys, I think we are finally live here. Sorry for the delay. We had started our video on there, but it looked like I wasn't able to connect, and so we got you guys on here. Can everybody hear me okay? Hopefully I'll be able to share my post. Oh shoot. Okay. Yeah. All right. Okay. We'll see if I can go back and, all right, guys, I'm going to continue playing the video. It's not allowing me to share my screen, so you guys can probably see it all the way, but you should be able to hear it. So let me go back to that. And if you're having any issues, just, unmute and just let me know. Okay.
Are those the only people right now?
Yes. Yeah. Okay, we'll go back to. All right, guys, I'm starting the video again.
Prices have been oscillating between $80 and $70 per barrel since November, and we haven't yet seen the same increase in gas prices of about 1% to $3.63 per gallon. But it is something to keep our eye on, as higher fuel costs will certainly be a headwind in the upcoming inflation reports if this continues.
And for the remainder of the week, there are some market news items. Today starts the two-day Fed meeting, and it'll end tomorrow at 2 o'clock Eastern time with their decision and Powell's press conference. And we know that they're going to hike 25 basis points. That's basically a lock, but it could get a little bit bumpy because we might have some tougher hawkish comments. We know that inflation has been moving lower. Are they going to acknowledge this, or are they going to continue being tough on inflation? They don't get the benefit of seeing this from this PCE report that could cause some market movement too. Now, there also are some other items like oil, Jake mentioned, and food prices, so we wonder how they're going to react to that. And then for the rest of the week, tomorrow, Thursday, we do have some bigger updates at 10 o'clock Eastern, and we get some housing reports. And then on Thursday, we also get GDP.
Thanks, team. Let's take a look at the charts. And what we do, you can see that mortgage-backed securities are down 11 basis points. They're a little bit off their worst levels, and they are battling an important floor of support here at 99.234, which is about the midway point between this big green candle that we saw here. If we can hold on to this level, we can go ahead and retest the 25-day moving average once again. But we do have to be on guard, because if we take this level, there's a long way down until the next floor of support here at this Fibonacci floor. And we take a look at the 10-year, is back up to 390. It's up 3 basis points, but that 390 level is a very important ceiling. So we have some critical technical floors and ceilings on mortgage bonds and treasuries that we have to be watching closely for ahead of the big news items, especially with the Fed tomorrow. But we can begin the day here carefully floated.
Okay.
So in English.
Yeah. Yeah. Right. I know. Yes. Here. Let me go. Let me see if I can go back to.
So
okay.
Points really is what? Like,
I know. Isn't this fun?
What is base?
Okay. All right. So basis points, when it comes to the market, is basically the level of support. Okay, that is being pumped into the into the economy that helps regulate what interest rates do. Basis points is basically a cost. It's like a fee. It's like, say for instance, if which he mentioned, like it's called support, where see this line. I wish I had my little red kind of in here. Oh, here, let me show you. This one's a little bit more clear. Let me go back this up. This is what's nice. I can kind of back this up a little bit. Yes, it is.
Understanding.
Yeah. All right. So here we are, say like July 25th. Okay.
Sure.
And so this is where we're at right now. So far, mortgage-backed securities are in the green. We're staying above this line here that he means, where it shows where the basis points are, where the market is kind of helping with, not necessarily interest rates, but the totality of everything that causes rates to possibly move.
Right.
This is where we're at.
Okay.
And he was saying if the Fed comes out, because they're going to have another big meeting, I think tomorrow, where they're going to decide whether they're going to bump interest rates again. They're going to test and see where inflation is and all of that stuff. So we just need to kind of get all that figured out. So if it does get, say, for instance, if they do cut it a quarter, or if it does get worse, this then drops below this line of support, which causes interest rates to move. Okay. And he was saying, well, if we get below this line here, we have all the way to drop to here before we start to get more support back from the market. So the more this goes up, the better. We need this to this will be nice when interest rates get better, is when our level of support increases over 100%, which is basically par for pricing.
Okay.
Like on our end, like here's an example. Say for instance, if they set the bar at 6%, okay, and 6% is this 100%, benchmark.
Right.
If a borrower wanted to get down to say like a 5.5, the basis points would slightly be a little bit higher, but they can obtain that, and we can lock them in at a certain price based upon where the market is. That's kind of how it is with points. It's all based upon where the market sets the interest rates at, based on the cost to pay to possibly get it and how much. So hopefully I explained that a little bit better than that. Yeah, right. Yeah. So those are the kinds of things that I just wanted to make sure, because that's what I love about these videos. I know it's a lot, but eventually you start to kind of pick up on what the market's doing and starting just to getting some knowledge for yourself and understanding that. I mean, it becomes a valuable tool.
So what's the prediction for end of year as far as interest rates go? I mean, 'cause people are asking like, well, are the interest rates gonna go higher or lower? I'm like, well.
Yeah. I mean, my projection is I don't think they're going to get any higher than they are right now. So I would say I would say the sevens will probably be it for this year.
Okay.
I mean, you're not going to see 8-9% interest rates. That's just not going to happen, because there's not what the inflation reports that are coming out now. It's getting lower. So they see that this is working, but we're also getting in towards the middle of the year, where, it's going to possibly slow down a little bit until you have the before holiday push. And so, yeah, so those kinds of things. And so it may kick back in, because, every time August comes around, it normally slows down maybe for a little bit, because, the people, families that have kids are getting them back in school and getting all that stuff straight. And then you have, when September, October come rolling around, now you're like, okay, well, then you get that next push of buyers and sellers that want to move or be in before the holidays. It's just how this has always been. Okay. So, yes. And so, okay, good. So it looks like I'm getting some messages on the board here. I'm glad you guys are able to hear, and thanks for staying in there. Sorry, we had some technical difficulties, before we got everything in to get everything squared away. Luckily, we got Emily here to help us out. So you guys can thank Emily, give her a big hug next time you see her, for getting you guys live. Now we're live and gone on here. So, and I know, since I can't share my screen right now, since I wasn't able to be made the host on this, guys, I do have some interesting handouts. So everybody that's on Zoom, I'm going to hand out these documents to you as soon as we're done. And so that way you've got them, okay? Because we're talking about a couple different really nice things here in regards to the market and the updates and things like that. So, well, here, let me see if I've got, I'll have everybody, if you can hear me in the chat, if I don't already have your email, post it real quick, and then maybe I'll send it to you real fast while we're going, so we can go over this together. All right, so here we go. Let's go. Because I already sent these to Kate, so I'll just forward these on. Okay. Yes. Soon. Oh, there it is. Okay. Okay, just one moment, guys. I'm gonna go ahead and copy you all on this email and then send it over to you. That one. Okay, we got Maria's. Okay, Jessica's, I'm getting yours now. Okay, Megan, I'm getting yours now.
And we're doing one tomorrow.
Okay. And then Michelle, I think I have yours, but I'll just copy it again, just so we've got it. Awesome, guys. Okay, I'm forwarding this email to you all now. All right, perfect.
Yeah, like my broken stem.
Okay, all right, guys, let me know if you got them in your email. I just sent them. It may take a moment to get there, but we're gonna start in order of the email that I sent on you. So the first one's going to be just the one that has the market update on here. We're gonna start with this one first and just kind of go over it, and because it's got some good, really good information on there. Okay. Right. Double check to make sure it went through on my end. Okay, all right. So I think it went through on my end, guys. So if you got it, just someone give me a, oh, you got it? Okay, perfect. All right, guys. So first we're gonna start with, this one here, the first one here that looks like it's, I just kind of typed it out when I was going through a couple of things. We're gonna go through this one first. Okay, I'll just kind of read through, we can talk about it, chat about it. Let me know if you guys have any questions, but this is some good information to go through. Okay, Johnny said didn't get it. Oh, okay, there you go. Got it. Okay, perfect. All right. All right, so starting, guys, I'm just going to kind of read through this and we'll just, kind of go. So the housing market interest rates are two interconnected aspects of the economy that have a specific impact on individuals, businesses, and their overall financial landscape. Understanding how these factors work and their implications is crucial for anyone looking to buy or sell a property, invest in real estate, or make informed financial decisions. In a comprehensive response, we will delve into various aspects of housing market and interest rates, including their relationship factors, influencing them, and the effects on different stakeholders. Okay, so basically what this first paragraph means is just making sure in which it's your job, it's my job to make sure the buyers and the sellers have as much information about what's going on in this market than ever before. I mean, I know I have kind of touched on this previously with some of the classes that we've done, but education is just, it truly is, guys, it's just more important now than ever, because buying a house is not only probably going to be the biggest financial decision that most people make anyway in their lifetime, it's also the one that's going to have the most impact for them in their future. And so that's why it's our job to really making sure that the client understands every aspect about the transaction, from not just me doing a pre-approval, but from you taking them and opening up that first door to show them a house the very first time, all the way through closing. It truly is vital, and it's lots of things are just need to be discussed so people understand what's kind of going on. And here's a great, topic for you guys, just talking about the housing market, just as an example. The housing market refers to buying and selling residential properties, including houses, apartments, condominiums, and other dwellings. It is a complex system influenced by numerous factors, such as supply and demand, which is what we're dealing with now, dynamics, economic conditions, government policies, demographics, consumer preferences, and so forth. I mean, it's not just inventory, but there's so many different things that kind of factor into what's going on with the market. And this is why it's such, it's just so good to understand kind of like what's going on. So everybody has a great understanding of what they can possibly share and help with their buyers and sellers. And obviously the first one, supply and demand, this is obviously the first pinnacle part of what's going on with the market, is just the balance between the supply of available homes and the demand for potential buyers plays a crucial role in determining housing prices. When demands exceed supply, prices tend to rise, creating a seller's market. Conversely, when supply surpass demand, prices may decline, leading into a buyer's market, which is kind of similar to what happened back in 2000 and when was it really? 2009 maybe, was really when there was so much inventory out there, but nobody was buying. People were like, I'm not putting my money anywhere, and rent was quote unquote a little more affordable at the time too. And it's just a different market than it was then. But now what we're seeing is the qualifications, guys, for buyers is a lot different than it was in 2009 as well. I mean, there was loans where you could get 100% financing for an investment property if you had a 720 score. You had no vested interest in purchasing their property, except good credit, and you could show that you could afford it. But what happened is that if you got into a situation where you're an investor purchasing these properties and all of a sudden the tenant moves out and you can't get anybody to go in there and pay the rent that you want, a lot of these properties they're just letting them go. They're like, well, I guess I'll just have to wait a certain amount of time before I can start to get more houses again and start in that cycle. And it was just unbelievable. So I think that's why a lot of programs and qualifications are now basically out there for buyers, because they have to qualify for the financing. There are still some out of box type of qualifications, non-conventional, non-conforming to the standard conventional or FHA standards through bank statements or 1099 programs or any kind of money market showing how much funds you have. Those kinds of things are still available, but there's different qualifications. The rates on them are higher. Normally you have to put a little bit more money down and so forth. But the standard conventional FHA, VA programs, they really do what they got to do to make sure these people can qualify for the property. So we don't have that kind of housing crunch again. So now when we're dealing with a less inventory, we're actually in a stronger market because these buyers are actually staying in their homes. The foreclosure rate has come down because people are able to qualify for it. So Harold, I see your note on there. You did benefit from that 0 down. Okay, well, good for you. I'm glad you're one of the lucky ones. And so, but yeah, let's kind of move on to economic conditions to kind of get a good understanding of that. So the overall state of economy significantly impacts the housing market. Factors such as GDP growth, employment rates, inflation levels, consumer confidence influences people's ability and willingness to buy homes, which is kind of like what they felt back in 2009. And during periods of economic expansion and low unemployment rates, there is typically an increased demand for housing. Conversely, during economic downturns or recessions, which is kind of like what we're in, but no one's really saying it, demand may decrease as people become more cautious about making large investments. So this is kind of like what we're dealing with now in some capacity, because they're trying to curb inflation. They're almost, forcing a recession. One of the next points is government policies. Another factor that plays into what's going on with our housing market is government policies can have a substantial impact on the housing market. Measures such as tax incentives for homeownership or regulations on lending practices can influence affordability and accessibility to housing. Additionally, zoning laws, building regulations, can affect the supply of new homes in certain areas. Okay, demographics, another good one. Changes in demographics also play a role in shaping the housing market. Okay, factors such as population growth, migration patterns, generational preferences can impact demand for certain types of housing. For example, a baby boomer generation ages, there is increasing demand for retirement communities and assisted living facilities. I don't know how much you guys have dealt in with that, but I mean, I'm starting to see more of these, retirement and assisted living facilities pop up all over the place. You know what I mean? Because people are, just getting older, and their families are wanting them to have, 24-hour care, people looking after them, if they have, especially if they have the funds to kind of help with those kinds of things, because it's such a great, asset and such a great, system that's being in place. But then that'll help with other homes, coming for sale. Okay. And then consumer preference. I like this one. This is a good one. Consumer preference and lifestyle choices also influence the housing market. Trends such as urbanization, sustainability, and technological advancements can shape the demand for specific types of properties. For instance, there has been a growing interest in eco-friendly homes, such as smart home techniques, in recent years. I mean, all these kinds of things, you're starting to see more of these solar panel like roofs. I'm starting to see some of the metal roofs are becoming more popular because you don't have to, I mean, I think one of them is good for what, 40 years. I think that's like what they're saying, how strong these things are, and, solar power, eco-friendly stuff, electric, all those kinds of things is really, part of the process and part of what's shaping the market, because things are just changing. It's a lot different than it was just 10 years ago, guys. And then obviously we got to talk about interest rates. And so what they are and how they change. And interest rates refer to a cost of cost of borrowing money, typically expressed as a percentage over a specific period. They play a crucial role in various aspects of the economy, including the housing market. And here are some, some points that we're going to touch on. The biggest one here, guys, is monetary policy, where basically what sets the interest rates and what, the central banks do. So interest rates are primarily determined by the central banks. So the central banks are, the big boys, there's the Bank of Canada, I know is a big one, the big European, I got to think about the top of my head. That's like the Swiss banks. Yes, those, plus our, the United States major banks are what kind of the US Treasury, all those kinds of things is what really factor in and what's going on with interest rates. And are mortgage-backed securities being bought by investors? Are they making money out of it? Are they starting to see some return on it? Because when you got a client that is got say a 720 or credit score or higher, okay, not necessarily how much they put down, but they've got good pay history, and their interest rate is, we'll just say 7%. Okay, that particular rate on the open market is going to be attractive for an investor for short term, so to speak, because they know they're going to, they've proven that they can make their payments on time based upon, that's why the credit score is such a huge factor, because it shows the borrower's ability to repay debt. That's the biggest factor of, one of the biggest factors in disqualifying. And so that's what's so important for that. And so when mortgage-backed securities get, backed, where we kind of saw on the market when we were showing where the different levels of support, it's where you have the investors go in there when mortgage companies, what they do is when they take their mortgage loans and they put them in like a big bubble, and they call it securitization. That means we've written all these loans under all the accordance of the guidelines through Fannie Mae, through Freddie Mac, and we vouch for these borrowers because we did our due diligence up front. We checked all the W-2s, the pay stubs, did all the screening to make sure there was no federal debt that was owed, or all these kinds of things. And it makes these mortgage loans attractive for these secondary market investors to go in there to buy these pools of loans up, which then frees up banks' credit lines, which gives them the ability to relend. Okay, that in a nutshell. I try not to make it too as confusing as possible. I know it probably was a little bit, but that's what keeps money going. Okay, and it keeps mortgage companies and banks free up enough so they can keep lending money. That's kind of how it is. It's not like you get a loan and you just kind of hold on to it until it's done. They securitize them and they sell them off to investors so they can make the money off of it and off the return and all of that. Okay. All right, so, but yes, let's flip the page here and we'll talk about just the actual mortgage rate itself. Okay, so mortgage rates are directly influenced by prevailing interest rates set by the central banks. When interest rates are low, mortgage rates tend to be more affordable, making home ownership more accessible for potential buyers. Conversely, when interest rates rise, mortgage rates also increase, potentially reducing affordability and dampening demand for housing, which is inflation, which is what we're going through right now. So the main thing with this, guys, again, is just making sure that we're getting people in the right situations where they, you know, they're not going to be quote unquote house poor, where they're not putting all of their money into their property. Sometimes they just need to, you know, get me a little bit more realistic, but still, you know, don't have a negative idea of purchasing, because even if they purchased, instead of a $300,000 house, they purchased a $250,000 house for now, you know what I mean, in order to just get their home and get it into something that they're going to, you know, for their families. Their value, the way that the market is, guys, and the way that things are as far as for qualifying, their value should stick. And then if they would end up selling their house, they may be able to sell it for $300,000 and then go purchase something else, because maybe rates will be different at that time and they'll have extra cash on hand. It's all about not discouraging people to, you know, to change their situation and just settle. And there's too much settling that's been going on, and it's just, it truly is unfortunate. And then the impact on affordability. Interest rates have a significant impact on affordability for homes. Higher interest rates, all those kinds of things. You know, it does reduce. That's pretty similar to what the mortgage was, but we'll jump back into investment decisions. This is a good one too. So interest rates also influence investment decisions in the housing market. When interest rates are low, borrowing costs decrease, making real estate investments more attractive, kind of like what we were saying. Then you can lead to increased demand for investment properties, potentially drive up prices. Conversely, when interest rates rise, the cost of borrowing increases, which may discourage some investors from entering the market. So that's a kind of another thing when you have a housing crunch and inventory is less. We'll get kind of into this, the LLPAs, the next, you know, page here. That really kind of determines what is going on, why it's such more cost for investors right now in order to purchase if they're looking for financing. That's why most investors out there are trying to buy as much stuff if they want to get something with cash, because they know when you're purchasing investment properties, the cost of it is just going to be higher, because, you know, they're putting these extra costs for investment properties because they want, you know, people to be living in them. They want these to be primary residence, not an investment property. So that extra cost is being put onto them, and there's no way around it. It's across the board with everybody. Okay. And so, but we don't have to go too much more to this. You guys got a good understanding of all this. I just wanted to make sure you guys had this information as a good reference to kind of have and kind of understand. And, you know, just so for time purposes, you know, I wanted to make sure you guys just had this as a resource to kind of go through, just so you had a general understanding of what's going on in the market today with rates. But just real quick, we'll kind of just touch base on the next page, guys, which is the LLPAs. Okay. When this came out, you know, I know a lot of people were kind of freaking out because they didn't really understand what was going to happen, why this is happening, and how does this affect me? So when the Federal Housing Agency, FHFA, which they showed on the video, they were talking about that, introduced these new upfront fees on conventional conforming mortgages for second homes, high balance loans, and cash out refinances. So high balance loans, we have seen between 1/4 and 0.75 increase based on LTV. And for second homes, the fees will increase between 1.125 and 3.875. There may be challenges, but there is a solution your clients can help them with, which is why I wanted to kind of show you here. And so for second homes, for cash out refinances and things like that, it's basically the same principle as the investors. You know, people that are buying second homes, because you can buy a property as a second home, a vacation home, and say, oh yeah, I'm not going to rent it out. After a year, you can rent it out. You know what I mean? So they're still implementing these extra LLPA changes because of the housing crisis and of inventory. So for instance, and if a borrower has really good credit, like you'll see here on the line, if you guys see this, I'm looking at the first line here where it says, or the second line, I'm sorry, a credit score of 760 to 779. Okay, so right there it's showing right now it's really not really affecting them as far as what their interest rate is because of their credit score. But once you get to, you know, even with just putting 3% down, it says 0.50. That's the LLPA pricing point that's going to be applied to them. That is still good. That is still customary based upon borrowing more. Okay. It's when you get to where you borrowers are putting down a little bit more money. I don't know why they did this, but you'll see on there where it says 0.375, where when the borrower is putting down 80% or 80 to 85% down, or LTV that we're focusing on, that's where they get those adjustments hit right there. You see it's higher than it is, and because it's a negative and not a positive. The reason that it's a negative instead of a positive, because when they're borrowing more, they know that the investor can hold on to that loan longer. They're going to have the PMI in there. That loan's going to be paid out for a longer duration, and so forth. So, but when you get to the 80% where it's showing the minus 0.375, it's because the borrower is putting down more, and there's no PMI. It's not as attractive on the open market. So they're making these LLPA changes to try to even the gap between a 740 credit score and a borrower that's got a 640. Yes. No such thing.
Could you explain what LLPA stands?
Yes, they're considered loan level pricing adjustments. Yes, loan level pricing adjustments. Yes. Yep. No, good question. Just so you know, guys, yeah, her question was, what does LLPA stand for? And it's loan level pricing adjustment. That's basically how rates and stuff are priced in the system for any kind of borrower that's looking to purchase, single family home or whatever. Those are LLPAs, or what the adjustments are for the pricing. No, good question. So this just kind of gives you an idea, because they're trying to make it some quote unquote, some more of an even playing field. Because if you got a borrower that's got a 659 credit score, and they're still going to give them some risk because they still have to put more, like their pricing and their rate is still going to be a little bit higher, but it allows them, if they do have a little bit more money, the flexibility to put down, the flexibility for them to to get more of a house. That's just how they're kind of doing it, and it's just good to be aware of kind of like what's going on in the market. So just keep this as a reference tool, but I'll handle all that talk and stuff with the borrowers. Okay. Yeah, good news for you guys, right? Okay, guys, and just last and not least, because I know we're getting short on time, I just wanted to kind of give you an idea of where mortgage applications are and where they're at currently, and just to kind of give you an idea of the people that are still out there wanting to at least get pre-approved. And so mortgage applications, and this is across the board, across the United States, has increased 1.1% in the week ending in July 14th. This is the closest update to current I could get as far as data. I know it's a week and a half off. I'm slipping, I know. Yeah, but that's all I could find. But following the 0.9 rise since the previous week. And this came from the data from the Mortgage Bankers Association, site that I have. And the applications to refinance a home surged to 7.3, but the activity accounted for only 28% of applications, and we're more than 30% behind last year, obviously because rates are higher and things like that. But what I think spiked it up is because, as you guys have seen, there's been a lot more credit card debt that's being used, or people are, a lot of the funds from when we got during COVID, when we had that, that extra money that was coming, all that stuff is, being used up and it's gone. So people are, charging, they want to do stuff or buy stuff or vacation, they're charging. And so, the reason for this uptick in refinances, especially cash out refinances, is to help, pay off some of those debt. Yeah, the rate may be higher, but if you're paying off 1, 2, 3, 4, 5 credit cards or installment loans, your overall monthly obligations still may have been lowered, because I'm sure the rates on those are going up too. The rates on credit cards I know are going up, those kinds of things. So at least, this is a fixed rate, and it's, and so forth. So, but also applications to buy home, fell 1.3% as home purchase activity is still being held back by low housing supply, which we know, and rates that are still much higher than a year ago. Meanwhile, the average contract interest rate for a 30-year fixed mortgage with conforming loan balances of 726,200 or less fell by 20 basis points, like we were talking about with the rate, to 6.87 from 7.07. So it's still going, but it has, slowed down a little bit. But as a market as a whole, that's just kind of where we're at. Okay, so. Yes, and on the market, like when it comes to interest rates, that's all based upon loan size too, and the cost of whatever that rate is. Like say, for instance, like we had a quick example with a say a borrower where the rate was 7%, but they wanted to get to a 6.5, and say it cost 1 basis point, 1 point to get that rate to be that lower. So whatever that loan amount is, say it's $100,000 loan, it'll be $1,000 to buy the rate to get to 6.5, and you can buy it and lock it in at that time for the whole duration of the loan. So that's kind of how it works. Yes, good question. Okay, so there technically there is, because, and guys, his question was, is there a cost on how many points a borrower can buy? And the answer is yes. Okay, but there's also a factor in how that can be changed. So yeah. So okay, so when you come to a borrower, every particular borrower that's applying for a house, okay, and based upon their purchase price or loan size, has a certain amount of fees that they cannot go over. Okay, those are the high cost calculation protocols, basically what they call it. So say for instance, the cost to buy a $300,000 house is going to be a lot more than the cost to say buy a $100,000 house. Okay, so we have to stay within the high cost parameters for a borrower to purchase a house, so they can't be charged over a certain dollar amount. So obviously the cost of points is going to be a lot higher that you can use to buy down on a $300,000 house as opposed to a $100,000 house. So it just has to stay within that high cost calculation in order for it to be approved. So most, I would say, a borrower can buy down without going over high cost is about a little over maybe 2.5 points. I'd say it's a good guesstimation depending upon the loan size. But anything over that, you know, they would either have to get seller concessions, which is great. But I mean, who can get I know it's tough getting those, but anybody that can somehow get seller concessions on a deal, that totally alleviates that high cost calculation, because we can apply that seller concessions towards their cost, which means it can allow them to get even more points if they wanted to. You know what I mean? It just helps offset that high cost when you have seller concessions. That's just an FYI once we get back to that realm of being able to get those.
Yeah, that's something we can negotiate in contract.
Yeah, absolutely. You know, it used to be a lot easier to negotiate.
Can you do it on a future purchase though? Like, so like we have, I have a buyer for a seller.
Okay.
And that seller can't complete the contract without finding another home.
Yeah, it's contingent.
Yeah, contingent for that. So can my buyer say, okay, I want to pay 2 points or whatever for you for your loan of your next house? That's all we can do.
Yeah, absolutely. Especially if he's going to do it in the form of seller concessions. Or are you talking about them purchasing their own house? Or are you talking like, you know, for the seller?
I'm talking about the seller. Their house is contingent on sale for them buying another property.
Okay.
And maybe they can't get approved for the property they want because
they need to sell first. Yeah.
They were asking, just as a creative way to do that to work, is maybe they can lower the price or something like that on the house that they're buying, and then the buyer can buy down points for their loan.
Yeah, absolutely. If it, you know, depending upon how much that buyer is putting down, will help them determine how much seller concessions they can get. Because obviously, if it's a first-time home buyer and the buyer is only putting down 3 to 5%, the max the seller is allowed to even credit them is 3%. So whatever that 3% is, as long as that's enough to help with what you may be referring to, we can either do it 2 ways: to buy their interest rate down initially and put it in the points calculation, or do a 2-1 or a 3-1 buy down, which means for the first year you buy the interest rate down a certain amount. Then the second year it goes to another amount until it goes back to its normal full. Yeah, it's like a temporary buy down. It basically covers the interest each month for that particular payment for 2 years or 3 years, or how long we set up the buy down for. That's one way of doing it, other than just using that money initially to use it to buy the rate down with the seller concessions. Yeah, so it's a good question.
I was thinking about creative ways you can do other things, because I was doing a showing for another agent that needed assistance, and I was talking with their client. Just they were saying how hard it is to get into some of these properties, and it was like the 5th one they're making an offer on.
Oh yeah.
And he's trying to, like, he's going 20 25 over, but you get to a point where you can't pay more because of what it is.
Yeah, and they got a gap.
I've been trying to think of like creative other ways that you can make your offer seem more enticing.
Sure. Nope, I totally get it. That's a great way of doing it, is saying, hey, I'll help you with, you know, I know buyers have been paying some of the seller's closing costs in some offers. I've been seeing that, you know, just to entice their offer even more. Like, hey, I'm gonna give you 3,000 towards your closing cost. We're gonna reverse this and see if it works. And it's working. So yeah. So lots of different things. But good questions, guys. Anybody have questions online here real quick that needs to go over everything? I know we're just at 12:03. I didn't want to take up too much time since we got the Zoom started late, but I know everybody's got their schedule. Anybody got any questions or need anything? I think everybody's good. Okay. All right, guys. Well, thanks for coming today. I appreciate it. Hopefully this was a little bit informative. Okay, great. Yes.
She said she was trying to get online when she had to.
Yep, here's a whole,
Thank you.
yep. All right, thanks, guys. Appreciate it.
I appreciate your support.
You're welcome. All right, have a good one, everybody.